So the narrative that full employment is strong and the GDP is strong, I think is just farcical. And again, it's not trying to be sensational. And then if you look at, again, the layoffs, the record-breaking bankruptcies, I'd say it's anything but a soft landing, and it's simply going to get harder. And we can go into each of those stovepipes specifically, but my general answer to you is, yeah, stock market's ripping. That's totally divorced from the Main Street economy. Stock market benefits primarily the top 10% of U.S. wealth. It's massive wealth transfer, benefits me. It doesn't benefit Main Street. It doesn't benefit the 450 companies that went bankrupt and the tens of hundreds of thousands of employees that were laid off last year. The BLS labor statistics about 700,000 new jobs ignores the fact that there were 1.4 million lost jobs, and of that 700,000, many of those are part-time jobs or people working 2 or 3 jobs. Again, you can get into the weeds of this. It's not sensational, but no, short answer, the real economy is very recessionary. The stock market is ripping, which is a very dangerous kind of divergence to see record-breaking all-time high S&P at the same time that Main Street layoffs and Main Street employment is stressed, and that GDP is based purely on trillions and trillions of dollars of debt.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Matthew Piepenburg. So Matthew is a partner of von Greyerz AG. So Matt, thanks so much for coming on the podcast today.
Oh, it's great to be back, Anthony. Looking forward to talking as usual.
Yeah, I think it's been close to a year since we talked.
Yeah.
And it seemed like the world was falling apart. I think it was during the banking crisis of 2023, but the Fed seemed to find a way out of that. But yeah, I guess from your perspective at the moment, things have seemed to be, from the economy have been going pretty well. At least markets are at all-time highs for most assets. So what is your current thoughts on what is happening in the world?
No, I think it's an important point. I think we have to be very careful about associating the economy with the stock market. They're two very different things. And it's funny, I was in Vancouver in January, and I'm a precious metals guy. I'm a macro guy. I look at debt levels and currencies, and I look at bond markets and Fed policies and dishonesty and disingenuity, which is fact proven. And they said, but Matt, what's your view on the markets? I'm actually very bullish on the markets when the Fed is acting dovish or talking dovish and then eventually becoming dovish. It's a massive tailwind for stocks. That was in January, and since then, of course, the markets have reached all-time highs. So has Bitcoin and gold and other assets. But it wasn't a surprise to me when Powell was talking dovish at the end of 2023, and then when even the last meeting last week, when he's basically said he's going to be forward guiding rate cuts sometime in 2024. That's a massive tailwind for risk assets. And it's also a massive indication they're going to devalue the dollar, which is another conversation. So and if you even look at volatility on the MOVE index on the Treasury, the markets are anticipating that Powell will actually stick to his word and cut rates sometime this year. So the markets are ripping, and they're ripping on actual net income margins on 5 or 6 names in the S&P 500, which I've said is the S&P 5, really. But it's not a surprise, but it's very important that we distinguish the ripping Fed-generated, Fed-dependent Pavlovian S&P and NASDAQ. Again, the NASDAQ is 50% of it is based on 10 names, and the S&P 500, as I've said, quantifiably equally weighted, is led by 5 companies. The other 495 are actually net negative since 2021. So yeah, the index of the S&P is ripping, the NASDAQ is ripping, NVIDIA is ripping, NVIDIA is ripping. But again, that doesn't mean Main Street economy is ripping. It's a debt-based economy. We've got 6% GDP growth based on 23 trillion in issuings of bonds and notes and T-bills, which have massive implications. And to me, debt-based GDP growth is not growth, it's just debt. And that's not an exaggeration, it's just simple math. And then if you look at the actual Wall Street indicators, as I've said many times in the year since we've spoken, if you look at the M2 money supply, which, Hanke at Johns Hopkins made a good point, that's always deflationary and recessionary indicator. When you look at the Conference Board of Leading Indicators, we went into a recessionary threshold at the December of last year, of 2022 into 2023. When you look at the layoffs, when you look at the real data, the BLS, not the reported data, and again, it's not sensational. Nick Eberstadt's done a finer job than me of looking at what real full employment really looks like, because it's not full employment. So the narrative that full employment is strong and the GDP is strong, I think is just farcical. And again, it's not trying to be sensational. And then if you look at, again, the layoffs, the record-breaking bankruptcies, I'd say it's anything but a soft landing, and it's simply going to get harder. And we can go into each of those stovepipes specifically, but my general answer to you is, yeah, stock market's ripping. That's totally divorced from the Main Street economy. Stock market benefits primarily the top 10% of U.S. wealth. It's massive wealth transfer, benefits me. It doesn't benefit Main Street. It doesn't benefit the 450 companies that went bankrupt and the tens of hundreds of thousands of employees that were laid off last year. The BLS labor statistics about, 700,000 new jobs ignores the fact that there were 1.4 million lost jobs, and of that 700,000, many of those are part-time jobs or people working 2 or 3 jobs. Again, you can get into the weeds of this. It's not sensational, but no, short answer, the real economy is very recessionary. The stock market is ripping, which is a very dangerous kind of divergence to see record-breaking all-time high S&P at the same time that Main Street layoffs and Main Street employment is stressed, and that GDP is based purely on trillions and trillions of dollars of debt, not tax receipts, not real growth, and certainly not foreigners buying our U.S. treasuries or Uncle Sam's IOUs. We are a debt-driven economy. We're flying on rotten wings, on the rotten tailwind of way too much debt and not enough national income. So, yeah, Pavlovian market, ripping on a few big names, ripping on real net income margins. That's true, just like Qualcomm and Lucent and Microsoft and other names, in Cisco I saw in the dot-com bubble, ripping on a few names that can last until net income margins decline. But the real economy, I'm sorry, quantifiably on Wall Street indicators, and frankly, just even on, I always say the Oliver Anthony anthem, this song in the US, I repeat it over and over. It's got, hundreds of millions of hits because the vast majority of people think that the rich men north of Richmond are screwing the currency and screwing the middle class. And I think that's true. He's popular not only in the US, but in Ireland and Norway too, because this is a global debt problem. It's a global recessionary problem. It should not be confused with blow off top in the S&P or the NASDAQ.
Okay, yeah, lots of places there.
Lots of there.
Thanks so much for thanks for laying it out for us. And if I touch on a really interesting point you mentioned there, is that, as you said, most of the assets are owned by top 10%. So I guess the bonds, the gold, equities, whereas most of the debt is actually owned by the bottom 50% as well. Because I guess that's why I can say that people are really struggling at the bottom because they have most of the debt. The interest rates are going up. They're being affected by that. But
sure, I mean, people on Main Street pay a very different interest rate than the interest on excess reserves that the banks pay or get paid. And the access to cash that people on Main Street or small businesses have is very different than the too big to fail banks. And, one of the benefits I have of being binational or being, half in the US, most of the time now in Europe, I've traveled throughout Europe. I've already been in a few countries this year, and last year I was in the north and the south of the U.S. I was in the Midwest. I've been in, Germany, Switzerland, France, Italy, the U.K., talking not just to hedge fund managers or gold investors, but to people on the street. And the mood is palpable. It's not sensational. Driving through Route 80 and going through Michigan and Ohio just after Christmas, you can really feel and see and hear the stress on the street, not just left-right politics, but the financial stress for the middle class. And as Walt Whitman said, the middle class is the heartbeat. It is the real soul of any country. And I see a middle class being eclipsed by what I call Wall Street socialism, where, the access to capital and the advantages of easy credit have benefited Wall Street for certain. And the too big to fail banks, they get bailed out by the Fed. They get bailed out by the BTFP programs. They get access to different programs that the Main Street businessman doesn't. That explains a lot of the layoffs. But what I see is Wall Street socialism, which is really insider advantages in a rig-to-fail system, but Main Street feudalism, where you have this extraordinary wealth transfer in the last 15 years, unprecedented. And again, not sensational. The image I have of Jeff Bezos and his income ratio to his average medium employee is simply psychopathic. It's never been seen before. And, him smiling while there's people in the warehouses, with aching backs. It's an exaggeration a little, but it's a symptom of a larger problem of the greatest wealth transfer in certainly American history. And I would say, going further back, we don't have titles like barons and marquises and lords, but we do have a new kind of feudalism. And I think that's being lost in translation because the world in the U.S. particular is so divided on politics, the woke movement, identity politics, arguing about transgender holidays on Easter at the White House versus a huge sucking debt sound right in front of us. But, politicians are good at distracting us in this tribalism that's going on culturally in the US and in Europe with immigration and other issues. But the real problem is financial and fiscal and debt, and it affects markets, it affects currencies. It certainly is going to affect the US dollar, and it's going to affect the gold price. So step aside, get 30,000 feet above all the noise, and look at the real reality. The world moves on high and low periods of economic strength. We just have a ripping market, but we have a very, very weak economy. And Germany's in recession. The UK is in recession. China's in recession. North Korea is in recession. America pretends not to be in recession. These are not exaggerations anymore. And to have a ripping S&P at the backdrop of this type of economic, quantifiable, objective economic recessionary stress globally and in the US, because when the NBER tells us we're in a recession, that'll be a year too late. And when the labor market, which is a lagging indicator, officially breaks, that'll be a year too late. But again, based on the indicators I mentioned earlier, we're already, in my opinion, and have been in a recession. Can't gloss over that with a rising market. But when the S&P in the top 5 names, which no longer, I guess, include Apple and Tesla, but when those net income margins expand, which they're doing now, markets will rip. When interest rates are low, markets will rip. But all markets revert to their mean. Again, I saw this in '99 with other big tech names that had legitimate profits and legitimate price inflation. But eventually, the cost and the volume and the price advantages of even the best companies on the S&P go through cycles. And when those net income margins go from positive to negative, which I can't time, but I can track, that's when the big long becomes a big short. And when I don't have the ability to predict the date or time, but when the mean reversion comes, and Jeremy Grantham and many others have said it's grotesquely overvalued. He's not a gold bug, and he's not a gloom and doomer. He's not a macro, try to scare you. He's a very, very smart portfolio manager, GMO. He's been through a lot of cycles, and he's not alone. Druckenmiller, Paul, Singer at Elliott, all these really respected equity and credit managers are saying, we're looking at an S&P mean reversion to 3,000 or 2,500. I can't time it. It's not going to happen now when net income margins are up. But when those net income margins contract, the markets will contract. And when they contract in the backdrop of a global recession, whether it's admitted to or denied, it's admitted to. The German finance minister or chief economist has basically said it's dramatically bad. Our PMI is at depressionary levels. In the UK, the mood is dramatically bad. So again, you don't hear that in the US press so much. But again, when this market bubble reverts to its mean or goes down, and we're already in a global recession, whether it's admitted to or not, that's much more dangerous than 2008 or the dot-com bubble. So I think this blow off top couldn't come at a worse time. I think even Powell's concerned about the exuberance of the risk assets right now, because that's the only good narrative we have, other than, again, full employment, which is completely, and we can get into, not true. And nominal GDP growth at 6%. But again, that's GDP growth based on debt. And to me, debt-based GDP at this level is not growth. It's just debt.
Yeah, and it all links back to debt. There's a really interesting. I was listening to a video from Joseph Wang, who's sort of known as the Fed guy, and he was talking about a comparison to French Revolution. Yeah. At that time, they were sort of trying to they confiscated all the assets from the church, and then tried to create their own system there, and it really affected people. There was basically hyperinflation, wages stayed the same, but the people who actually made the money were the speculators. So the investors. So it seems like that's sort of it. Maybe not that high inflation factor, but we are in that scenario where the speculators are just rolling in it.
I fully and completely agree. A hedge fund manager in the early 2000s gave me a book on the French national crisis in the 1780s on French QE 1, 2, 3, and 4. And it's interesting, if you track what the National Assembly was doing in the 1780s, it was extraordinary QE. And they completely corrupted the market system, completely crushed the middle class. And then what happened after all that exuberance was effectively autocracy, the revolution, Napoleon, centralization. It's funny, I've done all these interviews, and sometimes I get hundreds of thousands of hits. My favorite interview was a presentation I gave in Frankfurt. It's called The Cycles and Faces of Gold. And it simply tracks the French in the 1780s for about 45 minutes, how it mirrors exactly what the Fed has done since 2008 in almost every way. It's absolutely fascinating. So the point you make, I completely agree with. And I'm not trying to pitch this, but I really recommend people look at that link, The Cycles and Faces of Gold. It's on YouTube. It's fascinating how much what we're doing today mirrors what was done in France in the 1780s with what was effectively QE 1 through infinity. And that's what we've done. The difference between the French and the National Assembly in 1789 and the Fed in 2023, 2024, is that the US dollar, unlike the French assignat, is the world reserve currency. So we've been able to postpone the inevitable hangover, but the devaluation of our dollar, which we should get into, is now open and obvious. And the backdoor QE and the direct QE is open and obvious. So it is very similar to Wang's point about the National Assembly in the 1780s. I think people understood history and took a few examples, not just Weimar, Zimbabwe, or Yugoslavia in the 90s, or the ancient Rome, the great examples. But if you even look far, 1720 John Law, 1789 France, 2024 America, America is not immune from the sins of basically counterfeit mouse clicking millions and trillions and billions of dollars without killing the currency to save the system. And when you kill the currency to save the system, when you're in this much debt, you go from euphoria to centralization, from the extreme left or the extreme right. And that's exactly what we're seeing right now. We're seeing the debasement of our currency, and to Hemingway's point, we're seeing constant war, because you can buy temporary prosperity, as Hemingway said, at the expense of permanent ruin. Since 2008 or 2001, frankly, since 1913, we bought temporary prosperity for the markets, but we're going to create permanent ruin through inflation and permanent war. And when you look around and talk to anyone in Europe or the US, what do we see, especially in America, since I was born? Always at war. And now we have inflation, which is undeniably sticky and about to get much worse than reported. And that's not an exaggeration. That's the cycles of history. So I completely agree with your comment on France and the parallels to today.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Yeah, it's scary to think, and I think, as you said there, it's the fact that the US dollar is it's the main currency in the world, and it's probably the strongest economy. As you said, you look around the world, Germany's in a recession, UK is in a recession, China's really struggling. So it's not as if there's anyone that's going to come out and actually be able to compete with the US.
Yeah, and the US dollar is an extremely important topic because it does stem from debt. At the end of the day, every debt-soaked nation, regime, democracy, monarchy, you name it, again, going back throughout time immemorial, eventually you'll try to save the system by debasing the currency. And I've had a lot of debates with Brent Johnson, who I really respect, on the strong dollar thesis. But again, and I think the Fed is signaling loud and clear that they need a weaker dollar because America can't even afford a stronger dollar and higher interest rates. But I think the currency is the thing because the debt market is the thing, and that means the bond market is the thing. When you look at what's going on with the US dollar, there's the headline making topics of de-dollarization, and these are, since we weaponized the world reserve currency during the Putin sanctions just 2 years ago, myself, Grant Williams, Ronnie Sturfula, Jim Rickards, Andy Scheckman, all of us understood that this was a watershed moment. It didn't mean the dollar was going to die overnight. To Brent Johnson's point, it's still the best horse in the glue factory for a lot of reasons. It's still 80% or 85% of FX transactions. It still has the derivative markets, the Eurodollar markets, the SWIFT system. It's 80% of all trade settlements in the US dollar. We never said the dollar was going to die overnight, but the speed at which the world is de-dollarizing is actually even faster than I thought 2 years ago. You can't deny that anymore. So the de-dollarization thing is fascinating, but that's not really the end of the dollar. The end of the dollar will come from the central bank, the Fed itself, and we can go into why that's happening. The other thing that's fascinating and not talked about enough is just last year in the oil markets, the petrodollar markets. It's not a coincidence that, when we decoupled from the gold-backed currency in '71, that Nixon and Kissinger were running around in the Middle East trying to make sure that the OPEC nations bought our oil and made it bought in US dollars. That created a natural global demand for an otherwise unchaperoned paper fiat dollar. And for over 50 years, the world has been forced to buy oil in US dollars. That creates tremendous demand and strength for an otherwise debased and inflated currency. But what happened in 2023, which again isn't talked about enough, is 20% of global oil was sold outside the US dollar. That has extraordinary implications which haven't played out. And Saudi Arabia and the UAE are still pegged to the dollar, but so they don't want to see the dollar tank yet. But unlike Libya or unlike Iraq, and we know what happened to Gaddafi and Saddam Hussein when they tried to sell oil outside the US dollar, whether it was in gold or euros, well, they disappeared off the face of the earth. The Crown Prince of Saudi Arabia is not as worried, and Russia and China are not as worried as Libya and as Libya and Iraq were just not too long ago. There is a seismic tectonic shift happening in the petrodollar market, which affects the US dollar. That would be absolutely devastating. But what we're seeing in the GCC or the Gulf states is they're importing gold at record levels out of Switzerland this year, 2024. It's at record highs. I think what the Gulf states are doing slowly but surely is de-dollarizing, and they're going to slowly and surely sell more and more oil outside of the US dollar and net settle it in precious metals like gold. Again, this isn't sensational. This is happening. It's not making the headlines. These have massive, massive implications on the US dollar. So between the de-dollarization, between the oil trade, which is changing dramatically, and the fact that Russia can sell oil to China, China can pay for that, or Russia can sell it and take Chinese yuan and then convert that yuan to gold on the Shanghai Gold Exchange. There's all kinds of ways they can get around the petrodollar, and that genie doesn't go back in the bottle now. But in addition to these massive changes, the other thing that's tremendously headwind for the US dollar and proof to me that it's going to be continually debased is the level of US treasuries being issued right now is simply grotesque, and there's no foreign buyers for them. There's been net sellers of US treasuries since 2014, but the number of central banks that are dumping US treasuries and stacking physical gold in the last few years is simply unprecedented. And it's a warning sign. I've used the analogy, if you see an army marching towards your border and you see the cavalry and you see the picket lines and you see the scouts marching towards your border, that usually means something's changing, something's coming, it's time to be defensive. When you see central banks dumping US treasuries at record levels and stacking physical gold, that's not a gold bug argument. That's a sign that the world is no longer trusting that world reserve currency, which was weaponized just 2 years ago. So there are undeniable things happening with the US dollar. But as I said, the real blame won't come from the BRICS. It won't come from Putin. It won't come from the sanctions. It won't come from little green men from Mars. It won't come from global warming. The real reason the dollar is getting weaker is America's over its head in debt, over its skis in debt, and it's printing money and debasing its currency behind the scenes. We don't have yet an actual pivot to lower rates, but we will. Powell said it, but I think he'll have to do it because there's too many trillions of dollars worth of debt that have to be repriced this year. And if they don't reduce rates, Uncle Sam can't afford it. That's the fiscal dominance argument. But the other obvious thing is we've been doing QE for the last 5 years, about 4 or 5 times in the last 5 years. We've been doing backdoor QE. We emptied out the Treasury General account. That was Yellen doing backdoor QE off the balance sheet that Powell didn't have to admit to. We took money from the reverse repo markets. We had the BTFP program that phased out in March. We had trillions of backdoor QE. Then what's also happening now, which is not making the headlines, is this thing called the supplementary reserve ratios, which allow the Fed banks to basically use unlimited leverage to make unlimited purchases of US treasuries because foreigners aren't buying our treasuries. And all that is QE by another name. It's the Fed banks, branch banks of the Fed, big banks, are basically going to be able to buy all the US treasuries that Uncle Sam can issue because no one else wants them. So that just makes it's just off the balance sheet, QE by another name. And frankly, the most telling sign, which again isn't discussed, it's boring, it's bond stuff, but We have record levels of T-bill issuance. Again, that sounds boring. We're not issuing 10 years because there's no buyers, and we also want to take the price pressure off the 10-year Treasury, because when the yield spike, the interest rates get too high. But what the Fed is doing right now, what the Treasury Department is doing, 85% of the bonds issued are in T-bills, short duration bonds. Again, sounds boring, but as Luke Groen and others have said, that's a sign that you're clearly in a debt crisis. And using T-bills to take the pressure off the 10-year is just it's the last desperate QE-like attempt before we go to direct QE. And I can't time when we're going to go to direct QE, but all of these mechanizations that go behind the scenes that are unnoticed by the financial media, and frankly, intentionally confusing for most investors, and intentionally so. But the BTFP program, the TGA, the reverse repo markets, the T-bill issuance, and now this little very quiet SRS ratios, these supplementary reserve ratios, these are all Wall Street tricks to create liquidity, to take pressure off of the Fed, but it is just QE by another name. It is inherently inflationary. So we do have a currency crisis, and we do have an inflationary crisis. And I'll say one more thing before his monologue is, I'm not a big fan of Larry Summers. I consider him an arsonist who pretends to be a fireman. Larry Summers was the president of Harvard when I was there. He had a lot of controversy there. He was also a Treasury Secretary. His fingerprints are all over the Glass-Steagall bill, which basically turned commercial banks into hedge funds using depositor money for risk. He also, basically deregulated the derivatives markets, which destroyed Harvard's endowment and the rest of the world in 2008. So his fingerprints are over bad things. But he's a clever guy, and he's trying to look like a fireman now, despite being an arsonist. But he came out something recently on a tweet, which is true, that he said if you use the inflation measuring metrics in the pre-1983 housing metrics, that we would have had peak inflation last year reported accurately at 18%, not 3.7, 18% inflation. So that means we really do have negative real rates. That means we really aren't winning the war on inflation for a number of reasons. We're not. But as I've said many times, we're broke. The country's broke. Powell needs inflation to be higher than the yield in the 10-year, realistically, in terms of actual math. But politically, publicly, he has to misreport inflation, grossly misreport inflation. So between John Williams and Shadow Stats and, frankly, Larry Summers, we have double-digit inflation right now. Everyone on Main Street feels it, but the Fed tells us we're around 3.5%. It's just, as Jean-Claude Juncker said at the European Commission, when the facts are bad, we lie. That may sound sensational, but I think everyone listening to this knows that everything it costs a lot more, that inflation is misreported, deliberately so that we can claim to be winning the war on inflation. But we're really not. We need inflation. Powell needs inflation to inflate his way out of debt. That benefits Powell. It doesn't benefit the man on the street. It's just another rig to fail trick behind the scenes that very few people are aware of.
Yeah, it's a really interesting point. It might not be lying, but it might be using certain statistics that are going to shape the message that you want to deliver, because it's the classic notion that you don't say, what value will this add? If it doesn't add any value, why would I say it? That's sort of, I think a lot of these people look into,
If I were a Fed official, I'd say the same thing. If I were trying to keep my job and keep the system going based on words rather than math, I'd say the same thing. But I'm not constrained by a political party or a bank, so I'll just say what I think. And many people, I think, who look at the facts would agree. We can all have different opinions, but the facts are what they are.
Yeah, but it's all about narrative. So you mentioned pretty funny that the US is the best horse in the glue factory. Mm-hmm. I think, do you see in the next few months, potentially the next 6 months or so, that the US dollar could actually have a bit of a parabolic push up? Because if you think about it, it seems like the UK is going to cut interest rates early, the EU is going to cut interest rates early. Basically, the whole world is going to cut interest rates, but the US is probably going to remain quite consistent. Could you see something like that happening?
Yeah, I think the end game is very obvious to me. In the next 6 months, it's an interesting question. The end game to me, as I've said over and over, and I'll continue to say it, and Brent Johnson will disagree in the short term. He thinks the DXY is going to go up. I think that's a good diagnosis of where we were. I think the prognosis is different. I think even Uncle Sam, even the Fed, even Yellen, even Powell, and whoever's in the White House next year, we need a weaker dollar. We need to cut rates because we can't afford higher rates to pay back our own sovereign debt, whether it's on the short end or the long end of the curve. It's too expensive. And the S&P has over $750 billion in corporate bonds that have to be repriced this year. If we stay higher for longer, that's going to be crippling to the S&P, where we get a lot of our tax receipts. And Uncle Sam has over $8.9 trillion in IOUs that need to be repriced this year that roll over. So we really can't afford higher for longer. Now, Powell can do what he can do. I can't predict specifically what Powell will do, but my guess is, and he's already told us he's going to cut rates. We only have 6 more Fed meetings this year, and he hasn't cut rates yet. We can guesstimate. I think it'll probably be in September or towards the end of the year. I don't think it'll be as soon as June. I could be wrong. I do think he has no choice but to cut rates. If he cuts rates, that will be weaker for the dollar. If other countries cut first, then yes, the U.S. would be relatively stronger on a DXY measurement. Again, the best horse in the glue factory, but I say it's still, or the best patient in the ICU. I don't want to be the best patient in the ICU. I don't want to be in the ICU at all. That's why I invest in gold. But the point is, even relative strength of the U.S. dollar doesn't change the fact that its inherent purchasing power will get weaker. It'll just be relatively stronger than the other ones that are even weaker. It's not necessarily a contest I'd want to win. But to your question, if other nations cut rates faster and deeper, yeah, their currencies will sink faster and deeper than the U.S. dollar. And Brett Johnson does make a very good point. What other currency are you going to use as a trade settlement currency or as a safe or a regulated bond market? It's not going to be the ruble or the yuan or the peso or the British pound sterling or the euro or even the Swiss franc, which is a healthier currency than the dollar. The U.S. dollar does have supremacy, as Rick Rule said. It's just its hegemony and its trust is now irrevocably changed. But the most important reason I think the end game is inflationary and debasing is because even the Fed and Uncle Sam and the White House, whoever is in there, is going to need a weaker dollar, like the French did in 1789. So you'll get inflation in asset classes measured in currencies that are getting weaker and weaker, which is, again, one of the primary arguments for Bitcoin or for gold or alternative, anti-fiat currencies. Again, my bet is on gold. Certainly, it's more sexy to be in Bitcoin right now. I'm not against it. I'm not making fun of the speculators in it. It just doesn't have the same trust for me as gold does. And I think the U.S. dollar doesn't have the same trust that gold does. That's why central banks are stacking gold and not crypto and not U.S. treasuries and not U.S. dollars. And that's why the BRICS nations, they're not fighting the Fed. They're not fighting the dollar. They're just going around it, like the Maginot Line in World War II. And the French built all these forts so the Germans couldn't invade. The Germans just went through the Ardennes and went around the Maginot Line. And the BRICS nations aren't going to try and fight the Fed or create a new BRICS-backed currency this year. They're just going to net settle outside of the U.S. dollar. They're just going to go around the Maginot Line. They're going to go around the dollar. And eventually, I think the petrodollar system is going to see some serious stressors. All of these signs to me, in addition to the not QE that we already have, and then we're going to eventually have front door QE and not backdoor QE, and the addition of more rate cuts, to me, that all signals a weaker and weaker dollar. It may be relatively stronger than certain other currencies, but the world reserve currency just isn't what my dad's world reserve currency was. It isn't what the Bretton Woods world reserve currency was. We welched on that in 71. And ever since then, we've been exporting our inflation to everyone else. It was our currency, their problem. Well, now it's our currency, our problem too, because we can't afford the interest rates on our own debt. So we have to buy our own debt. We used to do it at the Fed. Now we'll use it through these SLS, these new tricks. But we're eventually going to have to resort to reflationary direct QE at some point. We're already doing backdoor QE now. We're cutting rates. We're going to do front door QE at some point. It's a repeat of what happened in 2018, the higher rates and the QT and the trying to reduce the balance sheet. It ended in unlimited QE in 2020, and I think Powell's higher for longer is the same thing. He's going to end up having no choice but what Luke Roman calls super QE, or I call QE to the moon. But again, my point is we've already been doing super QE. It's just been behind the curtains.
Yeah, and I think something I've been listening to, Russell Napier has been talking about this quite a lot. He's someone who talks about financial repression, and it seems like that's probably the way that we're going. And they've already done it to the banks. They've basically forced them to own, U.S. treasuries, and it backfired with the banking crisis. But that was sort of I guess you could say, a behind the scenes QE, making people own the treasuries. Now, I imagine they're going to try and do whatever they can to expand that to, other areas of the economy, pension funds, whoever has the cash to replace the international people who aren't buying.
Now, Russell's brilliant. Ronnie Sturflin introduced me to him a couple of years ago, and people should remember Russell Napier for years was a staunch deflationist, and then he started seeing what was going on behind the curtains in the UK in the banking system where you are, And when the Bank of England was effectively guaranteeing the commercial loans of the UK banks, that's indirect liquidity or direct liquidity. It's centralizing, it's repressing, it's forcing its way into these quote unquote private corridors of the commercial banking system. But, financial repression, even the higher for longer, that Powell's doing, it didn't make a dent in our debt. Our debt to GDP is 120% in 2009. That's 30% higher than it was in 2009. So we made no dent in our debt. Our debt to GDP has gone ripping north, and we still have inflation. Misreported, we still haven't beaten inflation, and an actual true inflation is significantly in the double digits. So there's going to be more capital controls, more centralization of the banking system. The two big to fail banks in the US and in Europe too are effectively going to be branch offices of the central banks. And I'm not even talking about central bank digital currency yet. I'm just talking about the ECB, the Bank of England, the Fed getting more and more involved into the financial policies of their nations and into the C-suites of these quote unquote independent banks. They're all this is verbunden, as we say in Switzerland. It's all connected. It's not exaggerated. It's not sensational. We're getting more and more centralized. And again, this goes back to the 1789 French example, or Yugoslavia, or Weimar, or fascist Italy, or Germany. Whenever you have a debt-soaked country or regime, you have a market crisis, you have a currency crisis, you have an inflation crisis, then you get social unrest, and then you respond to that social and economic unrest with extreme measures, extreme centralization, whether it's from the political left or the political right, because they're two stirrups of the same saddle, left or right today. It's all part of the same system to save their power, cover their butts, get more and more centralized at the expense of our civil liberties, at the expense of our currency, at the expense of all these other things that we take for granted in the last 10, 15 years, these financial freedoms, these free market price discoveries, this idea of being private, this idea of having control over your own checking and savings account, this idea of having control over your own decisions. All of that has dramatically changed in the last 3 to 4 years. It's not a coincidence that's happening at the same time that our countries are getting broker and less markets want our IOUs or our sovereign bonds. So we have to monetize them ourselves with mouse click money at a central bank near you that debases the currency and creates more and more distrust and more, again, social unrest. It's sad. It's a pattern seen throughout history. Again, it's a combination of understanding bond markets and debt markets and the cycles of history and politics. And I think we're at that fourth turning right now where things are falling apart, and you're going to see more centralization, more capital controls, more intervention from our central banks, less free choice, less civil liberties. And then again, that doesn't even go into central bank digital currency and that trend, which basically just makes us, frankly, no different than China 5 or 10 years from now, when you have your own social credit score and everything you purchase is going to be observable, and everything you write or say may be a positive or negative depending on who's in power, and you don't even have control over your own money. That sounds sensational. Sadly, that's the direction we're going. And a central bank digital currency is something the IMF is already forewarning us during the COVID crisis. They use that crisis as the excuse to roll out this concept, which will eventually become real.
Is there a way out of this without a massive debasement or without social unrest?
Oh, you were already seeing the social unrest. Literally, you're seeing it in London. I'm seeing it in Paris and in DC, and I'm seeing it in small villages. And we're already seeing that. We're seeing it constantly on the media. It's a slow drip by 1,000 cuts. It's constant negative news, constant tribalism, constant identity politics, constant left versus right, weaponization of the DOJ, weaponization of the law, weaponization of the fourth estate, the media, which is corporate owned. I mean, these are all symbols of centralization. I was sad to see it. When I was in law school or when I was an undergrad, I never thought the politics legal system could get this overtly obvious. I mean, even a man on the street can sense the intervention, whether you watch the left-wing media or the right-wing media. You only have one view. No one has a balanced view. There's very little public debate with informed debate. It's mostly emotional and political, so it's really kind of silly. But I don't think there is any way out from the social unrest to come, and the social unrest that's already here. I don't want to see more. I think America in this election coming up, regardless of who wins, is going to be permanently divided, because it's going to be half the country disgusted by whoever wins. And so I don't see an easy way out of that. In terms of the debasement of the currency, there's nothing that's going to make the inherent purchasing power of any fiat currency stronger. Nothing, whether that's the US dollar or the euro or the won or the peso. The relative strength can change depending on FX exchanges, depending on interest rate policies of different central banks, but the inherent purchasing power, what it buys for you, is just getting weaker by the day. Again, that's primarily why Bitcoin and gold are ripping right now. I personally think gold is a better asset for that. It is a medium exchange because it's literally what the central banks are buying and it's what the BRICS countries are net settling in. Bitcoin isn't that case. But again, I'm not against Bitcoin. I just don't trust it in the same way. But I think the rise in Bitcoin and gold right now is a middle finger to fiat money in general. The world's catching on. The jig is up on fiat money. And I don't think we'll see a gold-backed dollar or gold-backed brick currency. I just think we'll see a stronger role of gold net settling in trades. We may see some kind of redeemable central bank or a BRICS gold-backed currency down the road. It won't happen this year. I don't think we'll see the end of the petrodollar this year. But the signs of a weakening faith and a weakening trust in the greenback of the US dollar are literally everywhere, literally everywhere. So I'm very negative on the dollar's inherent purchasing power. I'm almost indifferent to its DXY because, again, you're just measuring donkeys and horses on their way to the same slaughterhouse. I'm not that interested in comparing equally sick animals. But yeah, of course, I recognize that the dollar is supreme. Again, its hegemony is irrevocably changed now.
So in history, how do we get rid of this wealth divide? Because I guess if you look at it, it went from labor in sort of the mid 20th century. Now we're into the capital phase. How do you get rid of it? Is it just absolutely destroying the value of assets and passing it over to labor? Is that the only way?
I mean, there's two answers. The dark answer is Hemingway's answer. You get rid of social unrest by distracting the masses with inflation and pain and war. Wartime economies, good guys, bad guys, creating narratives to keep your mind off the failures of your own policymakers, the failures of your own leaders to put you in this much debt where you're this desperate. Hemingway lived through 2 world wars. He was not an economist. He wasn't a central banker. He certainly wasn't a politician, and he certainly wasn't perfect, but he was blunt. And I don't want to see Hemingway be right, but he is already right. We do have permanent war, and we do have permanent ruin, and we do have inflation right now. The other way to distract the masses is tribalism, arguing about religion, arguing about sexuality, arguing about left versus right, arguing about immigration. Again, all valid things to discuss, but they distract us from the fact that our income is 1/3 of our debt as a country. In a family, that would create social unrest in a family. That would create marital unrest. That would create separations and divorces. If your husband's a gambler addict and you don't have enough money to put your kids through school or feed them in the week, that's going to break the family. Well, rather than focus on that reality as a country, we're distracting the country with all kinds of identity politics and polarizing politics. Can it be solved without pitchforks? Yes, I hope so. History has shown that usually it's violent and usually it's ugly and usually it's political or a combination of all those things. Pollyanishly, idealistically, hopefully, maybe through a fair democratic process, we elect more intelligent people who understand basic economics, who are not afraid to admit that we need austerity, not more mouse-clicked money, not more centralization. Like a family, you would talk about, honey, we need to tighten our belt. We need to spend less. We need to suffer a little, take less vacations. As a country, we need to trust our leadership to believe that. I think it's very hard for a politician to talk that honestly. Javier Milei has done that in Argentina. It's interesting. He's talked bluntly that we're broke. Peronism failed. We're screwed. We got to do something differently here. Not many Western politicians can do that. And frankly, not many Western voters are willing to hear that kind of negativity. They don't want to hear that either. They want someone to save them. So it's not just the fault of politicians, it's the fault of voters. But voters don't trust their politicians left or right the way they used to. The world doesn't trust our dollar the way they used to. I think Americans that I can speak for are willing to make tremendous sacrifices. That Kennedy quote, ask not what your country can do for you, but what you can do for your country. I think Americans throughout history have shown that they're very brave and they're very willing to buckle down when they believe in their government, when they believe in their fellow citizens, when they believe in their country. Even after a civil war, America was capable of doing great things. The problem today, politically and financially, is our country is completely spiraling into tribalism and factionalism, and it's a fractured society. It's a have and have not society, which is based on Fed policy and this rigged to fail system that I wrote about years ago. These are not dramatic things. Anyone walking around America, I've never seen it more divided, the divided states of America. You're practically looking at succession in places like Florida or Texas or Tennessee. It's not an exaggeration. People are picking their camps, red versus blue. And then there's all these other things that divide us. So I hope that there's some way that we can get past the sensationalism that's coming from our government, from our media, and come together and have a common vision of what America can be or what Europe can be or what England can be. That seems kind of idealistic right now. And I think it's harder to be idealistic when there's financial stress. When there's financial stress, it's very hard. As I've heard it said before, when you stand out in the rain long enough, you'll get in anybody's car. When you've got nothing to lose, you'll try anything. And a lot of citizens throughout the world that I've traveled through in the last year have no place else to go. They don't believe, and they'll get in anyone's car. They'll believe anything, and they're angry and they don't trust. So again, we're getting off of financial issues, but politics affect markets, markets affect politics, and that affects our experience not just in the markets or in our gold investments, but in our backyard. So you can't ignore these topics. I don't claim to be an expert on how to solve them all, but we have a lack of transparency about our debt, a lack of transparency about our foreign policy, a lack of transparency about our domestic policy, that everyone's just feeling like they don't know who to trust anymore.
Yeah, and it's as you said, hopefully there's a way out of it democratically.
Yeah, I hope so. I hope so.
Cause further social unrest. But yeah, Matt, thanks so much for your time today. Really appreciate it. Last question, what is one message you'd like people to take away from our conversation?
Well, again, I think the thing is to just never take any one pundit's word, not my word or anyone else's. If you have a strong view on something, take an alternative view. I really believe that's the one thing I took from law school, is the ability to look at two sides of every argument, whether that's politics, markets, the S&P, the inflation, deflation debate, gold versus Bitcoin, anything. Be very informed. Don't be stubborn. But look at cycles of history. Read some good books, not just the books that agree with you. Whether it's on global warming or whether it's on precious metals or whether it's on foreign policy, there's some pretty smart, informed people who spent their whole lives in those spaces who have objective opinions. I think we need to get away from emotional, 30-second, 50-second short clip attention spans and dig deeper into these issues. I think if you dig deeper into the banking crisis, the currency crisis, the central bank crisis, you won't have to think that things like Bitcoin or gold are just kooky alternative assets. That if you look at history, you've got to prepare for changes. You don't have to be afraid, but you have to be prepared. I think you have to really take a solid look at the purchasing power of whatever currency you measure your wealth in, whether you're in the top 1% or the bottom 1%. You have to think about preparation. I know it's hard. There's a lot of sensationalism in the precious metal space. There's a lot of gold bugging, and but to me, it's not gold bugging. It's common sense. You've got to preserve your purchasing power of your money. I don't think paper money will do it, and so it's good to take a deep look at debt, what debt does to currencies, and how you can hedge against currency risk, not just political and banking risk, which is everywhere. But really look deeply at what does it mean when you go from 9% to 6% to 3% to 15% inflation, compounding. What is that doing to the money in your checking account? You have to have, whether you're wealthy or not wealthy, you have to take measures to prepare for that. You can hope for the best for your political leadership, but become your own central bank, become your own congressman, your own leader. Take things seriously and do the best you can. And I know that's hard for a lot of listeners because they're just trying to get through the month. And I get emails all the time, Matt, great, but I can't even get through the month. I don't know how to buy gold. I don't know how to prepare for this. I feel like I'm just a twig on the river being pushed by forces I have no control over. I completely understand that. But again, even my son could spend $200 a month buying a little bit of gold every month, or whatever you think is going to hedge. But I don't think you can deny that we have a debt crisis today. You have a currency crisis. You have an inflation crisis, regardless of how it's reported. I don't think you can deny that if you're clear-eyed and open-eyed, if you have eyes to see and ears to hear. It doesn't have to be Matt Piepenburg's view. Look at other people who agree or disagree, but we all kind of come to the same conclusion. I had a big debate with Brent Johnson. I agree with 99% what Brent thinks. We're on the same page. Whether we think the DXY goes up or down is a debate, but we all agree that gold wins in the end because paper money dies in the end. I've watched Larry Lepard debate with Peter Schiff on Bitcoin versus gold, but they all agree that gold still does well. I think, Peter Schiff really doesn't like Bitcoin. He may be unfair, but I'm saying be informed, but look at your currency, look at the inflation, look at the debt in your country, and ask yourself honestly how they're really going to fix this, and question the wars they want to send you to, and question the narrative on who's the real good guy and real bad guy. I'm not going to tell you who I think it is, but do some deeper thinking than just what the left or right media tells you, and use your own common sense.
Great message. As you said, don't listen just to the one-sided news out there or other factors. Listen to everything, use your own judgment. But yeah, Matt, thanks so much for coming on. Appreciate it. If anyone wanted to find out more about what you do, where would the best places for that be?
Yeah, I mean, we are at vongreyerz.gold or vg.gold. Egon von Greyerz and myself write a lot of articles every week, and have a lot of informed opinion on not just why you should consider precious metals. I think a lot of people come to our site understanding that, but we also have a lot on our website beyond just our articles and interviews, a lot on our website that explains, what are the best jurisdictions to hold precious metals, why you should really be concerned about ETF gold or storing your gold at a commercial bank. It's more than just, why gold. It's also the how and the where of gold, which are very important. It's very important, if you can, to hold your gold legally outside of your own jurisdiction, outside of your own country legally. I think it's very important to hold it privately and not in a commercial bank. I think it's very, very important not to hold it in an ETF because of the counterparty and intermediary risks, which many people just don't understand, are pretty severe, especially as we head into more and more, banking and political crises. The family offices that I talk to, they're all concerned about inflation and geopolitics. So, how you own your gold is just as important as whether you should own gold. And that's what our website spends a lot of time trying to help people understand objectively.
Yep, great. I'll put that on the description below. But thanks again for coming on today. Really appreciate it.
Thank you, Anthony. Talk soon.